Thank you for tuning in to another edition of the Vulcan Report. This is your host, the Vulcan. Alright, hopefully I've worked out all of the kinks in the mic recording process, and if that's the case, then we can move on. Alright, here we have the spreadsheet for Monday, October the 23rd. As you'll notice that the highlights, you have the green section, and then you have the red section. The green section are those securities that we're looking to buy, and the red section are the securities that we're looking to sell, or I should say sell short. As traders, you know, we go both long and short the market. We don't just buy or go long only. We look to also sell short. As you also know, the problem with selling short on stocks, the only way you can do it is, actually you have three options. You can go long the puts, you can write call options, naked, if you will. That means you don't own the underlying security, or like I said, you can buy put straight out, or you can buy the inverse ETFs. That's pretty much the only options you have. If you try to sell short or stock, you have to first locate the stock, and if it's locatable, then you have to be able to borrow it, and then of course it can get called away by your broker at any moment, even if you're in the money, or if it's even going slightly against you. So you're sort of at the mercy of the broker when you're selling short a stock. If once you're able to locate it. So basically, what you're going to want to do is to go long an inverse ETF if you believe that a particular sector or market is going to decline. That's one way you can do it, and the better way to do it, if you have limited cash, would be just to go out and buy outright puts. Okay, so those are the options you're left with, no pun intended, if you're dealing with equities. Of course, if you're dealing with Forex, currencies, or futures, you can sell short those without having to locate shares, because there are no shares to locate, and those markets were created so that you could go both long and short. Okay? Alright, so with that said, looking at the spreadsheet for Monday, you will notice that we have quite a few things that we're looking to buy. But one thing I want to point out to you is I've been trying to answer a lot of the questions that I've been getting. I realize that a lot of people are new to trading the markets and are in need of a lot of additional resources and information, and I'm in the process of putting together a lot of learning material. I have some material already up on the blog at polscan.blogspot.com. If you go to the blog, you'll find it under the trading page. Just scroll down a little bit and you'll see it. They're in PDFs, and there are two of them there: Secrets to Successful Investing, and then there's Technical Analysis Introduction, and you'll find those there. I'm in the process of working on some other ones too as I get the time, which is very difficult to find time to do things these days. So anyway, that'll help answer a lot of your questions. Another thing that I wanted to point out too in today's report is the idea of money management. You know, it's one thing to call the market and to get your direction correct. Oh, I think the market's going to go down, or I think the market's going to go up. That's great. That's all well and good. But how are you going to profit from it? I've seen time and time again people who want to be analysts who say, "Oh, I've called the market right. It went up. I told you it was going to go up," or "It went down. I told you it was going to go down." But they don't have a plan on how to capitalize on that. I've seen people be right about the market and still not be able to make money from it. Okay? Trade management and money management is so crucial, critical, important to trading. Not only that, but how you enter the market is also just as important of how you exit the market. Timing and entry and exit points are so crucial, because if you enter at the wrong price at the wrong time, you can be stopped out and you will lose. Likewise, if your stop losses are not placed correctly, you can be stopped out prematurely. Or if your stop losses are too wide, you can lose an unnecessary amount of money when you are stopped out. So how to place stops and when and if to place stops are so important. I will be one of the first people to tell you that using stop losses are an excellent idea. Okay, you have to use them. However, there is a technique and a process in learning how to use stop losses. Sometimes you're going to want to use a hard stop, meaning as soon as a trade is triggered, the stop loss is automatically executed. But how you use the stop loss and what type and method of stop loss to use is also a technique involved. You may use a normal stop loss, but you also, when it comes to equities, you may not choose to use a regular stop. You may choose to use options as your stop loss, which is usually a better idea. So I say all that to say you just have to know how and when to use the right tools at your disposal. Also, the order types. There are dozens of order types, depending on what broker you use and what exchange you're using, that benefit you as a trader. You have to know when to use market orders, when to use limit orders, what type of limit orders and stop limit orders to use. All these things come into play. You have to know how to place these things so that you can benefit in the market. Failure to use trade and money management techniques correctly at the right time will lead to unnecessary losses and even substantial losses. So it's not enough just to call the market. Remember the video I did a while back saying watch who you listen to? There's so many people on the web, on the internet, on YouTube, want to be analysts, predicting crashes in the market, predicting bull markets, predicting all these things. But you never see them give you trade management and money management ideas and techniques that can be used, that can be easily documented for historical record. They always say, I told you the market was going up. Look at these excellent calls, market calls we have. But they never give you the trade management part of it, because they know that when and if they did that, it would expose the nakedness of their system, of their trading, of their market calling. I will also caution you that most people that are on YouTube and on the internet doing these technical analysis videos don't even trade the markets, and they have no money exposed or at risk in the markets. And they don't have other people's money exposed or at risk in the market. So again, be careful who you listen to. Everyone wants to be an analyst, everyone wants to be famous, everyone wants to have people following after them. And unfortunately, especially on YouTube, some people have thousands of people following them. And they're leading them astray, leading them into the ditch, leading them into poverty and financial ruin. Please watch who you listen to. I'm not going to say any names, but there are those individuals on the internet and on YouTube that have thousands of people following them, and they are not traders. They do not trade at all. And they don't manage money. And they've never worked on Wall Street. Ever. Ever. They didn't work for any firm. Now, I will say this. Not everyone who worked on Wall Street physically worked on Wall Street. In other words, most firms are located away from Wall Street. But it's still Wall Street. So that's not the big deal. The big deal is not whether you actually sat in an office in New York City or not. The big deal is, were you a licensed, associated person with either the NFA or the SEC or the NASD or the CFTC, NFA? Were you a member? Did you have a securities license, whether it be a Series 7 or a Series 3 or a Series 65 or what have you? Were you a principal of the firm? All these things are important when you're dealing with people, okay? So I just want to caution you guys. Also, I'm going to be doing a video on this Hindenburg Omen thing. You know, there's so, I told you guys before in videos before, there's so many analysis techniques and systems and all these things out there. And even a broken clock is right at least once a day, right? But I say all that to say that, okay, you have a Hindenburg Omen, whatever. Remember what I told you, 95% of all traders, investors lose 100% of the time. Excuse me. So do you really think that the talking heads on TV are going to get it right? Of course not. All right, the mainstream media always gets it wrong. I did a video the other day talking about a possible war rally. What in the world do you think that means? It means that the nations of the earth are getting desperate and they're about to go to war. That is the only way to rescue and recover a broken economy. So don't think for 1 second that that cannot happen. Even if it doesn't, even if a war doesn't break out before 2010 is over. Don't think that they can't manipulate and pump it and sensationalize it and keep the market from falling, and as a matter of fact make the market rally and hit new highs, new all-time highs. They can do whatever they want. All I'm saying is follow the charts, people. Read the charts. Let the market tell you what it's going to do. It's good to have a bias of what you think is going to happen, but you got to trade what you see. Don't just trade what you think. Trade what you see. All right? And then the profits will worry about themselves. So anyway, I digress. Please look at the chart. I've been working really hard and really diligently trying to help you guys make as much money as possible. But keep in mind, the markets haven't been doing much in the last several weeks. They've been consolidated, trading within a sideways pattern. Okay? So you don't really have a clear direction. You just have to get in and get out. Get your profits and get the heck out of the market. I'm serious. If you got profits on an intraday basis, get out, take profit. All right? And then live the trade another day. I redesigned the look and the feel of this of the InPlay printout, and you'll notice the security name on the left, on the far right, the ticker symbol. All right? I've even made it so that the ticker symbol is in the name on the far left to help you read it a little bit better. Right here, the first column after the security name is the short price. All right, the short price coincides with this box over here, the sell signal. If there is a 1 there, that means you now have a short selling possibility. Even if there is a potential pulse wave breakout or breakout long buy signal, you can't ignore that sell signal. It's telling you that that market is either topped out or something, or has broken a critical support level, or is about to, and you have to watch it. So you would have to actually do some work, and you would put in both signals. So for instance, on the GLD for Monday, you notice a possible pulse wave scenario. So you got to put that buy in at 120.99. Okay, here's your stop loss, 119.41, but you can't ignore the sell signal. Okay, so you got to go over here and put in a ticket to sell short at 116.40. All right, and once you put your ticket in to sell short at 116.40, you can go in and you can put your stop loss in at this 119.41 level. Okay, I'm trying to help you guys out, trying to help you make some money. Please pay attention with these things. I'm trying to make it as easy and simple as possible. Anyway, more can be said. If you have any questions, just post a comment or send me a private message, and I'll help you out as much as possible. Remember to take what you can, give nothing back. Peace.